Right now, somewhere between a headline about a rocket that didn't land the way everyone hoped and a stock chart that suddenly turned red, there's a very real chance you're sitting on the exact kind of opportunity that shows up once every few years, and almost everybody watching it happen is going to miss it completely. Every time something big and flashy like a SpaceX setback grabs the news cycle, the whole market flinches, momentum names get dumped first, and panic spreads into corners of the market that had absolutely nothing to do with what actually happened. That's exactly what's unfolding again, and by the time we're done today, you're going to understand exactly where the real opportunity is hiding while everyone else is busy staring at the wrong stock. Before we get into it, if you want more breakdowns like this one, hit subscribe on Tickerhawk right now, because we're about to walk through something most channels aren't even talking about yet, and you don't want to miss where this leads. Here's the thing nobody wants to admit out loud. Every single time there's a dip like this, it doesn't matter if it's tied to a rocket launch, a rate decision, or some random headline that gets blown out of proportion, the market treats it like the whole growth story is suddenly over. And every single time, that turns out to be the wrong read. Because underneath all that noise, there's a buildout happening in this country that is bigger than almost anything we've seen in our lifetimes. And it has almost nothing to do with the day-to-day drama that's rattling headlines. This week, we're talking about the race to build enough computing power, enough data centers, enough raw electricity to run the next generation of technology. And here's the part that should really get your attention. The companies that are actually going to make the real money from this aren't necessarily the flashy names you already know. They're sitting quietly in sectors that most retail investors have never even considered, and some of them are still trading like nobody's paying attention. Let's talk about what's actually happening in the market right now, because context matters here. Since early June, the broader tech-heavy index has basically been chopping sideways, down a few percent, after an incredible run earlier in the year that saw it climb close to 20% in just about 2 months. That kind of move doesn't last forever, and when momentum stalls out like this, the hot trades that ran the hardest tend to get hit first. That's exactly what we're seeing. Stocks that were up triple digits are pulling back 10, 20, sometimes 30% from their highs. If you've been investing through the last few years, you already know this pattern. We saw something almost identical happen in the fall, where the market chopped around for months before finally breaking out again once fear cooled off. History doesn't repeat exactly, but it sure does rhyme, and patient investors who understood the bigger picture were the ones who came out ahead. It's also worth noticing what's happening on the other side of the market, because it tells the same story from a different angle. A lot of everyday consumer businesses, the ones selling directly to regular households, streaming services, car makers, restaurant chains, even some of the big payment card companies are actually down for the year or barely moving. That's not a coincidence either. Money is rotating very deliberately away from the general economy and directly into the physical backbone of artificial intelligence. When you see that kind of split, expensive areas getting cheaper while cash keeps flowing into a specific narrow lane, that usually isn't the end of a trend. It's the market telling you exactly where to focus. Now here's where it gets interesting, because not every part of this trade has run up the same way. If you look at where the real gains have piled up this year, it's concentrated in chip makers, memory producers, and the hardware side of this whole build-out. Meanwhile, plenty of everyday consumer-facing companies are actually down for the year, and that split tells you something important. This isn't a market where everything goes up together anymore. It's a market that's picking winners very specifically, and the winners are the companies tied directly to the physical infrastructure behind artificial intelligence. A lot of people are going to make the mistake of thinking that because some of these chip and hardware names have already had their moment, the whole story is played out. That could not be further from the truth, and I want to show you exactly why. Because there's a bottleneck sitting right underneath all of this that almost nobody outside of industry insiders is talking about. Start with memory chips, because this is where it gets almost hard to believe. One of the biggest American memory makers just reported earnings, and their own executives came out and said they don't even have visibility into when supply is going to catch up with demand, looking all the way out to 2028. Think about that for a second. This is a company that plans factory construction a decade in advance. If anyone on the planet should know their own production timeline, it's them. And they're telling you they can't see the finish line. On top of that, they're openly saying customers are only getting somewhere between half and 2/3 of what they're actually ordering. So if a major buyer places an order for 100 units, they might walk away with 60. The rest simply doesn't exist yet. There's nowhere else to get it, because there are really only 3 companies on the entire planet making this kind of memory at scale. 1 here in the United States and 2 in South Korea, and every single one of them is already sold out for years to come. That kind of scarcity does something very specific to a business, and the numbers back it up. Revenue at that same memory company went from around $9 billion in a quarter to over $40 billion more. then 4 times bigger in just 12 months, with gross margins climbing to levels that almost never happen in a healthy, well-supplied market. When margins spike like that, it's not a coincidence. It's proof that demand is completely overwhelming what's available. And before you think new factories are going to fix this anytime soon, understand that the plants being built to add capacity won't be fully online until anywhere from 2027 to as late as 2030. On top of that, the type of memory needed for artificial intelligence systems eats up roughly 3 times the manufacturing capacity of ordinary memory chips, which means every chip built for AI doesn't just use supply, it actively crowds out supply for everything else, your laptop, your phone, your car. This is the kind of squeeze that doesn't resolve itself quickly, and if you're an investor looking for value, this corner of the market deserves serious attention. Drop a comment below and let me know if you already own any memory names, because I want to see how many of you are ahead of this trend already. But memory is really just one piece of a much bigger puzzle, and honestly, I think the bigger opportunity is sitting somewhere most people aren't even looking, which is the power grid itself. Every data center needs enormous, reliable electricity, and right now the entire system is jammed at every single step. Ordering a gas turbine, the machine that actually generates power, can take close to 8 years. Simply getting permission to connect to the power grid can take almost as long. Even something as basic as a high-power transformer can take 5 years to arrive. Compare that to the 2 to 3 years it takes to physically construct a data center building, and you start to see the real problem. You can build the building fast, you cannot get the electricity fast. Global data center power demand is expected to nearly triple by the end of the decade, and the total investment needed to build out this infrastructure is measured in the trillions of dollars, even under conservative estimates where some projects get delayed or canceled. And this is exactly why so many people are wrong when they say big tech companies won't keep spending on this build-out unless they see instant profits. That kind of thinking misses the bigger picture entirely. For the companies leading this race, staying in the game isn't optional, it's survival. Whoever falls behind in AI infrastructure risks getting left behind permanently, and that's true, not just company to company, but country to country. Whichever nation keeps building the fastest ends up leading the next era of technology, and there's already a long history of governments stepping in to support industries considered strategically important. The real long-term risk here isn't some repeat of an old dot-com style collapse, because the companies driving this spending are some of the wealthiest, most dominant businesses in modern history. The more realistic risk worth watching is international competition, particularly from countries willing to move faster with fewer restrictions. But that's a story for another day. Right now, let's focus on where the actual money is likely to be made, because this is where things get exciting, and I promise you it's worth sticking around for. Roughly 16 gigawatts of new data center capacity has been announced this year alone, but only about a third of that is actually getting built, and somewhere between 30 and 50% of announced projects are getting delayed or scrapped entirely, not because companies ran out of cash, and not because they ran out of chips. They ran out of power. That single fact tells you everything about where the next wave of opportunity is likely to come from. So let's go through the names that stand to benefit the most from this exact bottleneck. And if you're the kind of investor who likes finding value before the crowd catches on, you're going to want to write a few of these down. Constellation Energy, ticker CEG, operates one of the largest fleets of nuclear reactors in the country, and nuclear checks 2 boxes that matter enormously right now. First, it runs continuously, day and night, regardless of weather, which matters enormously, for AI systems that can't just pause mid-training. Second, their fuel costs are locked in through long-term contracts, while the price they sell electricity at floats with the market, which is an incredibly favorable setup when demand is surging. They've already restarted a previously shut down nuclear facility, specifically to serve a major technology partner, and they've signed multi-decade power agreements with some of the largest companies in the world. Then there's Vistra, ticker VST, which operates a much broader mix of power generation, including nuclear, gas, coal, solar, and battery storage. That flexibility means when demand spikes, they can pull from whichever source is cheapest and sell into whichever market is paying the most. They've already locked in a massive 20-year agreement covering multiple power plants with a major tech company, and their recent earnings blew past expectations by a wide margin. Since connecting directly to the power grid takes so long, plenty of tech companies are building their own small gas-powered plants right next to their data centers, which means somebody has to supply that gas. Energy Transfer, ticker ET, is one of the biggest players here, with an enormous pipeline network and a growing list of long-term contracts feeding data center hubs across the country. It's worth mentioning that this one is structured as a partnership, which means a slightly different tax form at filing time, so it's something to look into before buying, but the underlying business model is about as steady as it gets. since they get paid the same toll whether gas prices go up or down. Kinder Morgan, ticker KMI, plays a very similar role, but as a standard corporation, so the tax paperwork is simpler. Their own leadership has stated publicly that a majority of future data center power demand sits directly along their existing pipeline network, and their credit rating has recently been upgraded, which says a lot about how the market views the strength of this business right now. On the nuclear fuel side, Energy Fuels, ticker WOWO, operates the only fully licensed operating conventional uranium processing facility in the entire United States. Not the biggest, the only one. Considering how much of this country's power strategy now depends on nuclear energy, having just a single domestic processing site tells you how tight this supply chain really is. And this company is already on pace to hit its annual production targets well ahead of schedule. Uranium also has to be enriched before it can be used in a reactor, and for decades, a large portion of that enrichment was outsourced overseas. Centrus Energy, ticker LEU, is the only American-owned uranium enrichment company, holding contracts worth billions of dollars along with government backing to expand domestic capacity. If you believe in the long-term nuclear power story, this is about as close to the source as you can get. Then there's GE Vernova, ticker GEV, which builds the massive gas turbines and transformers required to actually generate and move electricity. Their turbines are already sold out through the end of the decade. Not strong demand, not a healthy backlog, completely sold out. If you wanted to order one today, you'd be waiting years just to get in line. And finally, for anyone comfortable with a much higher level of risk, there's a small, early-stage company working on micronuclear reactors small enough to sit directly next to a data center, completely bypassing the years-long wait for grid connections and pipelines. Nano Nuclear, ticker NNE, represents that kind of speculative, high-upside bet. If this technology proves out at scale, the payoff could be enormous, but this is very much a long shot. Style position, and should be sized accordingly, not treated the same as the more established names we just covered. Here's what I want you to take away from all of this. Short-term dips, whether they're triggered by a rocket, a rate decision, or just plain market jitters, tend to shake out the impatient money and reward the people who understand what's actually happening underneath the surface. The AI buildout isn't slowing down. It's shifting into a completely different phase, one built on physical infrastructure, electricity, and raw materials, rather than just software and chips. That shift is creating pockets of the market that are still genuinely undervalued, even while other parts of this trade have already run up hundreds of %. If this breakdown helped you see the bigger picture a little more clearly, do me a favor and drop a like, leave a comment with which of these companies you're watching most closely, and share this with somebody who's still only paying attention to the headline, names everyone already knows about. And if you haven't already, subscribe to Ticker Hawk, because we're going to keep tracking this story as it develops, and you don't want to miss what comes next. As always, none of this is personal financial advice, so make sure you do your own research before making any investment decisions. I'll see you in the next one.